Hello and welcome to the Asset Nivesh channel. So what do you think really drives the Indian equities market? Is it economy health in general, like GDP growth? So if the country's GDP is doing good, does it mean that the stock market is going to perform as well? Well, what is GDP? So GDP is the sum of all the incomes that is earned within the country. That includes wages, salaries, profits, and rents. Now, GDP is also a reflection of government spending, consumption spending, investment spending, and net exports. So, do you think good GDP growth will predict better stock market performance? Well, that is partially correct though, because GDP has a profit component in it. So, there is a positive correlation between the GDP growth and the stock market performance. Well, the stock market is very volatile and it does not exactly follow the trajectory of the GDP growth. Now, why so? Because one fundamental basis for stock market performance is that it is forward looking and is driven by the expectations about how the economy is going to perform or how the company or a particular industry is going to perform. Well, that is not the complete picture. There are many variables at play which will impact the stock market performance, even though there isn't much change in the industrial output. One such variable is US Fed actions. So if US Feds they go hawkish, that is they increase the interest rates, so that will force RBI to do the same. Now an increase in interest rates will adversely impact banks, real estate, discretionary spending sector, or wherever debt is involved. These stocks will go down and so will Nifty 50. Why so? Because these stocks they carry heavier weights in Nifty 50. Now, if RBI does not increase the interest rates, then that will put downward pressure on rupee because the currency carry trade will become less attractive, and the FIIs, the foreign institutional investors, they will find attractive investments in stable economy which is characterized by dollar. So are we really left at the mercy of FIIs? Not really. DIIs, domestic institutional investors and retail investors, they have been our saviors. We have seen that in last few years, they have been reducing the impact or the influence of FPI outflows. Now, another factor is the political stability, which also impacts the movements of stock markets. This is obvious by now because we have seen in last few election results day that there have been movements in the indices. Last but not the least is the human psychology, which kind of amplifies the factors that you have discussed before, and it further swings the stock market performance. So to conclude, it is not easy to spot the outperformance. My advice, get a financial advisor. Thank you.